Did you know that a seemingly small difference in interest rates can cost you thousands of dollars over the life of a loan? It's true, a difference of just 0.5% can add up to a mountain of extra payments. This is why understanding interest rates is crucial for anyone borrowing money. Whether it's a mortgage, a car loan, or even a credit card, the type of interest rate you choose can have a significant impact on your finances. So, buckle up, Buttercup. We're about to dive deep into the wild world of fixed and variable interest rates. We'll break down the jargon, expose the risks and rewards, and arm you with the knowledge to make informed financial decisions. Because when it comes to interest rates, knowledge is power and potentially thousands of dollars back in your pocket. Let's start with the basics. What exactly are fixed and variable interest rates? In simple terms, a fixed interest rate is like a steady eddy. It stays the same for the entire term of your loan. Think of it like a predictable, boring friend who never throws any surprises your way. A variable interest rate, on the other hand, is more like a roller coaster ride. It can go up or down over time, depending on market conditions. This can be exciting or terrifying depending on your risk tolerance and how much you enjoy unexpected drops. Choosing between a fixed and variable interest rate is one of the biggest decisions you'll make when taking out a loan. It's like choosing between a reliable sedan and a flashy sports car. One offers predictability and peace of mind, while the other comes with the potential for both thrills and spills. The choice between fixed and variable interest rates is rarely easy. It's a decision that keeps borrowers up at night, staring at the ceiling and wondering which option is best for their unique circumstances. There's no one-size-fits-all answer, and the decision often comes down to a personal assessment of risk tolerance, financial stability, and future expectations. Are you the type of person who values predictability and peace of mind above all else? Do you prefer knowing exactly what your monthly payments will be, regardless of what the market throws your way? If so, a fixed interest rate might be the right choice for you. Or are you more comfortable with a bit of risk? Do you believe that interest rates are likely to fall in the future, and are you willing to gamble on that possibility? If you're comfortable with a bit of uncertainty and have a higher risk appetite, a variable interest rate might be a better fit. Fixed interest rates offer the comfort of knowing exactly what you'll pay each month, no matter what happens in the market. This stability can be a significant advantage, especially in times of economic uncertainty or fluctuating interest rates. Knowing your monthly payment amount allows for better financial planning and can help avoid unexpected financial strain. For many, this predictability is worth the extra cost, as it provides peace of mind and a sense of control over their financial future. Your interest rate is locked in for the life of the loan, providing a sense of security and stability. This means that even if market interest rates skyrocket, your rate remains unchanged. This can be particularly beneficial for long-term financial commitments, such as mortgages, where even a small increase in interest rates can lead to significant additional costs over time. This can be particularly appealing for borrowers on a tight budget who need to know exactly how much they'll be paying each month. For families and individuals who have to manage their finances carefully, the predictability of fixed payments can make budgeting simpler and more effective. It eliminates the worry of potential payment increases, allowing them to allocate their resources more confidently. However, this predictability comes at a price. Fixed interest rates are generally higher than variable rates at the outset. This higher initial rate is the trade-off for the stability and predictability that fixed rates offer. Borrowers must weigh the benefits of a stable payment against the potential savings they might miss out on if interest rates were to decrease. Fixed interest rates are typically higher than variable rates at the start of a loan. This is because lenders are taking on the risk that interest rates might rise in the future, and they build this risk into the initial rate. By charging a higher rate, lenders protect themselves against the possibility of future rate increases, ensuring they maintain profitability even if market conditions change. This is because lenders are taking on the risk that interest rates might rise in the future, and they build this risk into the initial rate. Borrowers need to understand that this higher rate is essentially an insurance policy for the lender, covering the potential for increased costs down the line. It's a calculated decision that requires careful consideration of one's financial situation and future market expectations. So, while a fixed interest rate can provide peace of mind, it's important to weigh this against the potential cost savings of a variable rate. Variable rates can start lower than fixed rates, offering immediate savings. However, they come with the risk of future rate increases. which can lead to higher payments. Borrowers must consider their risk tolerance and financial flexibility when choosing between fixed and variable rates. If you're comfortable with a bit of risk and believe that interest rates might fall, a variable rate could save you money in the long run. Variable rates fluctuate with the market, which means your payments could decrease if interest rates drop. This potential for savings can be attractive, but it's essential to be prepared for the possibility of higher payments if rates rise. Ultimately, the choice between fixed and variable rates depends on your financial goals, risk tolerance, and market outlook. Section 5. Variable interest rates. Riding the market wave. Variable interest rates, also known as adjustable or floating rates, are tied to market interest rates. This means that your interest rate can fluctuate over the life of the loan, going up or down depending on market conditions. This can be both a blessing and a curse. On the one hand, if interest rates fall, your monthly payments could decrease, putting more money back in your pocket. This can be a significant advantage, especially if you're planning to stay in your home for a long time. However, if interest rates rise, your monthly payments could increase, potentially putting a strain on your budget. This is the risk you take with a variable rate. The potential for savings comes with the potential for higher costs. Section 6. When fixed wins, a tale of two borrowers. Let's say we have two borrowers, Jane and John, both looking to buy their dream homes. They are excited and hopeful, but they have different approaches to financing their purchase. Jane is a cautious soul who values predictability and wants to know exactly what her monthly payments will be for the next 30 years. She spends hours meticulously going over her financial documents, calculating her mortgage payments down to the last cent, and reviewing fixed-rate mortgage agreements. John, on the other hand, is a bit of a gambler and believes that interest rates are likely to fall in the future. He enjoys analyzing stock market graphs, discussing market trends in meetings, and exploring variable mortgage options that might offer lower rates. In this scenario, Jane would likely be better off with a fixed-rate mortgage. She signs the agreement with confidence, knowing that her payments will remain stable, and she and her partner shake hands with their mortgage advisor, feeling secure in their decision. She's willing to pay a slightly higher rate up front for the peace of mind that comes with knowing her payments will never increase. This stability allows her to plan her budget more effectively, and she feels a sense of relief as she holds the mortgage documents. The couple smiles with their new house keys, ready to start their new life. John, however, might be better off with a variable rate mortgage. He reviews the variable rate mortgage documents carefully and discusses his options with his advisor, weighing the potential benefits and risks. He's comfortable with the risk that rates might rise, and he's hoping to capitalize on the potential for lower rates in the future. John spends time looking at interest rate charts, reading financial news, and talking to his mortgage broker to stay informed about market trends. This is just one example of how the choice between fixed and variable interest rates can depend on individual circumstances and risk tolerance. Each borrower must consider their financial goals, market conditions, and personal comfort with risk. There's no right or wrong answer, and the best choice for you will depend on your unique financial situation and outlook. Consulting with a financial advisor can help you make an informed decision that aligns with your long-term goals and provides the best path to achieving your dream home. Section 7. The choice is yours, weighing the factors. So, how do you decide which type of interest rate is right for you? This decision can significantly impact your financial health and future planning. There are several factors to consider, including your risk tolerance, which is essentially how comfortable you are with taking financial risks. Are you comfortable with the possibility of your interest rate fluctuating, or do you prefer the stability of a fixed rate? Your financial situation plays a crucial role in this decision. Are you on a tight budget, or do you have some wiggle room to accommodate potential rate increases? If your budget is tight, a fixed rate might offer the predictability you need. Your outlook on interest rates is another important factor. Do you believe that interest rates are likely to rise or fall in the future? If you think rates will rise, locking in a fixed rate now could save you money in the long run. The length of your loan term also matters. Longer loan terms generally benefit from fixed rates, while shorter terms might allow for variable rate advantages. This is because over a shorter period, the risk of significant rate changes is lower. Carefully consider these factors and weigh the pros and cons of each interest rate type before making a decision. It's not just about the numbers, but also about your personal comfort and financial goals. It's also a good idea to talk to a financial advisor who can help you assess your options and make the best choice for your individual circumstances. They can provide personalized advice based on your unique financial situation and future plans. Remember, the right choice for someone else might not be the right choice for you. Take your time, do your research, and make an informed decision that aligns with your financial well-being and future aspirations. Section 8. Share your story. Join the interest rate conversation. Choosing between fixed and variable interest rates is a big decision with long-term financial implications. It's a decision that many of us have faced, and each of us has our own story to tell. Have you ever grappled with this decision? What factors did you consider? Are you happy with the choice you made? Share your experiences and insights in the comments below. For further reading on this topic, check out the resources available on the websites of reputable financial institutions like the Consumer Financial Protection Bureau or the Federal Reserve. Remember, knowledge is power. The more you understand about interest rates, the better equipped you'll be to make informed financial decisions that benefit you in the long run.